Hi guys, welcome to our next video. I hope you've seen the previous ones because we are continuing our discussion on Dow theory. And in this video, we are going to talk about the second rule or second tenet of the Dow theory. The second tenet states that the market has three trends: the primary trend, the secondary or intermediate trend, and the short-term trends. Now, we will talk a little bit about all of these trends. Okay, now the primary trend particularly is one which lasts between 9 months and 2 years. Okay, so it can go on anywhere. Now, if you want to see a typical business cycle, it lasts for approximately 4 years. Now, check out this chart which I'm sharing with you guys. Okay, this is the Nifty monthly chart. Okay, and if you want to see these moves, you can probably determine what I'm saying. A typical business cycle from trough to trough goes on for 3.6 years. So this is from 2009 to 2012. Okay. Then we had this cycle which went on from 2012 till 2016. Okay. Then we had another business cycle which went on from 2016 till 2020. And now we are in the next business cycle. So every 4 years, approximately, statistically, the value is 3.6 years is how much a business cycle lasts. Now, in a business cycle, you will probably have certain months of a bull trend, okay, and then certain months of a bear trend. So if it's a 4-year cycle, ideally, it should be 2 years of bull trend and 2 years of bear trend, right? But that is generally not the case because it takes more time to build something than it takes to break it down. So same way in the market, the bull trends generally tend to last a little longer than the bear markets. Okay. So what is a primary trend? A primary trend is which is the prevalent trend in the market. Okay. And if that trend has been prevalent for 9 months or more, okay, it is considered to be the primary trend. Okay, so here each of these candles that you can see here represents 1 month, and each of these vertical lines, they represent 1 year. So you can see here the primary uptrend went on for 2 years and the downtrend went on for 1 year or maybe a little over that. Same way, again here, the uptrend went on for 2.5 years and the downtrend went on for approximately 1 year. So that is 12 months, right? So a primary trend is defined as anything that is a market direction that has been prevalent for um, at least 9 months, and it can probably exceed even till 2 years, as you can see in this case, right? So this is how you identify the primary trend of the market. Now, when you are trading or when you are trying to analyze a stock or deciding upon an investment, you have to first ask yourself, okay, what is the primary trend? Okay. So this is how you identify a primary trend. Okay. Now, this is the monthly chart. If I were to make this a weekly chart, okay, where each candle were to represent a week, okay. Now, let me see how this show you how this thing would change. So anyone who observes a primary trend, okay, will agree that the market does not move up in a straight line, right? The market first goes up, then it goes down, okay, then it again goes higher than that, then again it comes down. So the market ka uptrend is always interrupted, okay. Now, why is this interrupted or what is the scene? Is because the trends because there are different types of people in the market. So the long-term people, they would hold and they would wait for the entire trend to play out. But there are short-term players too, swing traders who book profits at regular intervals, right? So for that, the price would correct a bit and then continue going up, right? So this is typically how the market goes. So there are counter cyclical trends within the confines of a primary bull market, okay, or even the primary bear market. Okay, and these counter cyclical trends, okay, which go against the market, okay, they go on for several weeks or even certain amount of months. Even though the price trend is up, these trends, these counter cyclical trends are there. So this is an uptrend. You can see that there it is interrupted by several downtrends which go on from few weeks to few months time. Okay, so this can be from 6 weeks to 9 months. Okay, it can be for all those durations. So here each candle is a week. So you can see this counter cyclical trend, it has gone up, okay, for a span of 3 months. Out here also counter cyclical trend has gone down for a span of 7 months. Okay, so while the primary trend is up, okay, we are getting these counter cyclical trends which are of equal importance within the confines of the primary bull market. Okay, so these are your intermediate trends. They go against the primary trend, but they are not having enough power to beat the bull market. So you can see that here, even though so it's a bull market, even though there is a price move here, the price moves past this high. Okay. Then again, there's a counter cyclical move here, but the price eventually moves past this high. Again, there's a counter cyclical move here. The price moved past this high out here. So every time the price keeps making a new high, despite of it taking a break of any time between 6 weeks to 9 months, right? So to several months actually, right? Sometimes counter cyclical trends can also go on till 9 months, but those are very rare occasions that happen. Okay. Now, apart from this, if I were to load the daily chart, right, you would see that despite of these counter cyclical trends which are there, there will also be uh, uh, shorter term trends in the market. Okay, and these shorter term trends that are there in the market, oppose they are they last for few days, 3 to 6 days, certain amount of weeks, etc. Now these comprise of market noise. Okay, if you're an investor, it is noise. If you're a trader, maybe not. Okay, so typically, here's what I'm trying to tell you, that if you are a long-term investor, you are concerned with the primary trend. Okay, whereas if you are a short-term swing investor, you are more concerned with the primary trend as well as the intermediate trend. And if you're a small, even more short-term trader or an insider trader, you're concerned with all the three trends. Okay. Now, this is a typical picture which denotes what I've been trying to tell you. Okay. This picture is taken from the Martin Pring textbook. Okay. Here you can see that as a general rule, longer the time span of a trend, easier the trend is to identify, that we saw in the chart. Here you can see that how the business cycle is for 4 years. You can also see the intermediate trend denoted by this black line, which interrupts the short-term trends, right? Interrupts the primary trend. And then there are shorter trends which interrupt the intermediate trends, which are represented by this dotted line. So this is typically how the market moves. Okay. Long-term investors are majorly concerned with the direction of the primary trend. However, short-term investors and traders must be aware of the direction of the longer trend as well as the intermediate trend and the short-term trends as well. Okay, they should not get fooled by the intermediate trend thinking that this stock is now going to crash if the primary trend is still up. Okay, because surprises can occur in the direction of the primary trend. Okay, apart from this 4-year cycle which you can see there also, and the primary trend which I explained you, that can go on from 9 months to 2 years. Okay, there exists a larger secular trend which goes on for anywhere between 10 to 25 years. Okay, so if I were to show you the chart of the US market, you will observe the secular trend. Okay, let me just show you the chart. So here I'm showing, this is the Nifty chart, right? Don't worry about the chart, guys. We'll cover that next week as to how you should study the charts and all those things. These are just basic rules that you need to look at. We will look at the Dow Jones Industrial Average, what we just studied, okay? And we will look at the monthly chart. And you will come to know that, see, despite of everything, there is a secular trend of the market. Since 2009, this market has been going up. We are in 2021. So since 14 years, there have been a few interruptions. You can also probably observe the same for 4-year cycles here also. This one, this one, this one, maybe shortened longer. In this, the cycles will not be perfect because the US economy has done something called as QE. We'll get into that in our later discussions. Okay, but you can see the secular trend of the market right from 2009 till date. It's been going up. Here also, right from 1986 till 2000, 14 years bull market was there. Even before that, there was a bull market, but that was a normal one. So you can see that there exists secular trends also in the market for extremely long-term investments, which you can consider. Okay, but these are generally useful when you're studying time cycles and market cycles. Okay, for your and my purpose, our three trends, which are primary, intermediate, and short-term trends, are enough. And yes, so before I conclude, okay, I want to just reply to one certain query which keeps getting asked, okay, which is, how do I identify a trend? Okay, now people ask that, okay, fine, visibly you can make out ke ha ye upar ja raha hai, this is going up, this is going down, but how is there any method for identifying a trend? Okay, so for that purpose, I will again load the Nifty chart. Okay, and I'll load the monthly chart of Nifty, and I will zoom this in also, right? And let me get rid of the drawings. There we go. Now you can see that, okay, let me load the weekly chart. Okay, now you can see that this market has been in an uptrend for uh, the last few years. Now, how do you identify an uptrend? Uptrend is when the market keeps making higher tops and higher bottoms. Okay, so for example, if you're identifying the weekly time frame, okay, out here the market is going down, then out here it's made a higher top, and this was the bottom, it has made a higher bottom. Then again here it made a higher top, and again here it made a higher bottom. Again here it made a higher top, again here it's made a higher bottom. Now here it made a higher top, and here it has not made a higher bottom. Okay, so this section entirely is an uptrend without any doubt because of higher tops and higher bottoms. But here the market has made a same bottom, it's not made a higher bottom, so that is a red flag. Okay, so once this red flag comes, you have to be very cautious, because now if the market makes a lower top, then there is some danger in the market. But this didn't happen. The market went higher, it made a higher top again, so the uptrend continued. Then it made a higher bottom, then again it made a higher top. But then see what happened out here. It broke past that bottom and went down. That is when the trend changed. Okay. Now, typically in a downtrend, the stock makes a lower top, a lower bottom, another lower top, another lower bottom, and then once that lower bottom gets taken out, the trend changes. Okay. This is a very simplified way of identifying what trend is going on in the market. Okay. Sometimes there can be traps also, because this theory is not exact perfect theory, and market does tend to trap people also. But for that trap, for identifying all those things, there are several other technical indicators that are going to help us. And yes, so this was about the market having three trends: primary, intermediate, and small trends, small short term trends, and about how to identify the direction or the trend of the markets in general, right? Again, guys, don't forget to like, share, subscribe. We will see you in the next video with the next rule of Dow theory. And yes, bye, guys.